Hi, this is Jared Friedman from Redwood Financial Planning. In this video, I want to talk about risk. Please stick around. When making personal investments, there is a stigma that taking risk is a bad thing. We constantly hear that we need to reduce our risk, pare back our risk, diversify our risk as much as possible. And by doing this, we are expected to receive better outcomes. But in reality, that's not always the case. So you see, the stock market rewards those who are willing to take risk. It does not guarantee those rewards in any specific amount over time, but in the long run, those who take the most risk generally receive the biggest rewards. For example, the investors that had the strength to invest in 2008 or 2009 have experienced the most gains over the last decade. And rightfully so, because at that time we all thought the world was ending. So the biggest risk was to put more money into the market, and a few years later, the rewards arrived. With COVID-19, the financial rewards came again, but a lot quicker. But the risks were even more scary. However, this is not a video about how we all need to take more risk to achieve better returns. Instead, it's about the other side of the story, the side that talks about understanding our investments better so we know how much risk we are actually taking. Now, we all use the word risk, but what is risk? In the investment world, we call that the measure of volatility. Yes, how much can your portfolio potentially move around? That is risk. Because when your portfolio moves more than you were expecting, you suddenly feel that you are taking on a lot of risk. And at that point, risk becomes very bad because you will most likely do something, take some action that will probably lead to a bad for your financial future option. So in general, risk is not bad at all. Volatility is not bad. Take as much risk as you want. If you know that going in, and if things go off the rails, you shouldn't be surprised to see your portfolio move around. But more importantly, do the research to understand the risk that you are taking. Looking backwards, we can see that bonds are less volatile than stocks. Small companies are more volatile than large companies. Mid-cap stocks maybe are less volatile than emerging markets, and etc. and etc. We know this ahead of time. An easy way to determine how much volatility is in your portfolio, just look backwards. Go back to April and May of 2020 and last year as well, 2009, 2008. How do you feel seeing these numbers again? Do you want to take on more risk or reduce it? Neither answers are wrong, but you have to accept the decision. Flip-flopping in good times and bad times is another bad move because things can turn on a dime in the markets and you'll always be a step behind. My advice to you is to evaluate your portfolio today. Remember that those who take more risk typically get rewarded in the future, but you have to be able to endure the volatility along the way. I hope this video made you think about risk a little differently. Thank you for watching. Please subscribe to our channel so you don't miss out on any future videos. And as always, I hope you achieve financial success.